So friends, we start now with the US dollar. We had a lot of data today, very big variety of the data. So if you have been focusing to our trading plan, you have already received into the previous videos looking at still our trading plan working very well. We hit now the new levels. Here we are at the US dollar and the US dollar, the DIX index. We see that after the data, the GDP data we have been receiving, so this market typically should go down, but it does not, and there are a lot of factors to continue this video. We later will go to the crypto market, and I had also some, and we will talk also about Ethereum, we will talk about Solana, we will talk about gold, we will talk about euro dollar, about S&P 500, Nasdaq, and last not least, of course, and must talk about the oil market and the VIX. We see here, I had a question of one of the viewer that he was looking for VIX indicator. I'm going then also to mention that again. So as I told you, the VIX indicators I am using are developed by ourselves only. That means we use them, but we are not going to give them away in public way. This is a new VIX indicator, but combined with linear regression EMAs. The linear regression EMAs, in this case, together with VIX, they calculate the current VIX value, the look back of the trend of the price of today and the past price. They calculate automatically the distance between those prices and the numbers of bullish and bearish trends in the past, and they forecast where the price will go in the future. Like now, for example, we see here very clearly, so that in this area, for example, we had then a temporarily bullish tension of Bitcoin that was of the opening price, and then the line changes the color, but on the same time after the data came out, a lot of people were buying here, but all the time the indicator mentions no, just take the short trade because we will go much more deeper, right? So in Tradingview, as I said, you will have a lot of VIX indicators, so you need to research yourself personally that, because the indicators we are using, these are only for our own trading stuff that we have been creating, some by myself, some by other team members together, whatever. So if you are some programmers and you need then some ideas, you can tell us, then there we can then privately talk about, right? We see here that Bitcoin price going down, and this is very important to know what factors are influencing especially the Bitcoin price at this moment. We have a lot of forces, right? So that are dictating the Bitcoin should go down and should go deeper, and they have already done and dictated this price down from the past, not because the indicator is telling that, the indicator just showing it will go down, indicator doesn't tell you the factors. The importance is that the fundamental factors or the macroeconomic factors that are surrounding the markets are dictating that. And the VIX says something is coming. It is not specifying that housing data market are coming down. Nasdaq will go. It says VIX is up, go down immediately. And if you don't do that, it happens immediately and you go against the trend and you will lose. That's all, right? So the technical side of the market is always the timing, right? And that's the way how I am trading, that we look 99% on the fundamental markets of the inter-market analysis, of the intra-market analysis, and the inter-countries, globally, intercontinental market analysis of different countries, not only the United States, but also a lot of countries. So we are researching for, let's say, between 6 to 8 hours. If we are trading 10 hours a day, we can say that the technical taking the trades is just about 15 minutes. So to take those trades, right? So to analyze 3,500 markets, it takes around maximum 1 to 2 hours a day, not more. We just check. So I just check the markets fast after each other because I know the patterns, I have the data in my mind. So I say, okay, stay out, buy, sell, stay out, stay out, stay out, buy, sell. That's all what we do. And behind of that, 8 hours additionally are the fundamentals. Without fundamentals, no long-term success in trading. I guarantee you there are a lot of people who are telling it the opposite, but I doubt they are right because they last maybe for 2, 3, some years in the market and nobody else is hearing from them. And the fundamentals that are matters, and the volatility, of course, that matters. So why the market like the market are like now? There are a lot of factors. We begin first with the relationship between economic data such as GDP, gross domestic product, currency, exchange rates, which can be complex and influenced by various factors beyond straightforward cause and effect relationship. And there are a lot of reasons that the US dollar might be strengthening despite a decline in the US GDP. So the reason number of one is, for example, the market expectations and pricing in data, that currency markets often reflect expectations and sentiment about future economic conditions rather than reacting solely to current data releases. If GDP data shows a decline but is within expectations, or if other leading indicators suggest potential economic resilience like employment figures, consumer sentiment, trade remarks, already have factored this into the market pricing. And we all know that the US dollar was, is, and will always be the safe haven demand. So there's a big safe haven demand for the US dollar there, no matter what comes. Of course, we have also ups and downs in the US dollar, but the long-term trend is going up and up and up, and there is no other chance for pseudo currencies like Bitcoin or something like that. That's just a new trend, new design product. But against the US dollar, they have no power. So the US dollar is considered a safe haven currency, meaning it tends to strengthen during times of global economic uncertainty or market turbulence if investors perceive increased risks elsewhere. For example, geopolitical tensions, global economic slowdown, and they may flock to the US dollar for safety, causing its value to rise, like we have seen, for example, Iran-Israel war. Then we have the interest rate expectations of different nations compared to the United States, as currency values can be influenced by expectations of central bank policies, particularly interest rates. If the Federal Reserve is expected to raise interest rates due to concerns about inflation or to support economic recovery, this can attract investors seeking higher returns on dollar-denominated assets, such boosting demand for the US dollar. We have, of course, the global trade dynamics, changes in global trade pattern, commodity prices can impact currency values if there's increased demand for US exports and changes in global trade economics. And we have, of course, relative performance of the currency exchange rates that are relative even if the US economy is underperforming compared to expectations. If, for example, other major economies are experiencing similar or worse conditions, the US dollar may still appear relatively stronger compared to other currencies. And last not least, we have, of course, the technical side of the market. We have algorithmic trading, we have key technical levels on bigger time frames, and so on and so on. Now back to the news of today, what have been released, the movement of the stock indices like S&P and Nasdaq that have been influenced, of course, last not least, by the bad earnings of the companies, which we have been expected since the beginning of this year, already are coming down, especially Facebook. The earnings season is continuing to the next week, and Nasdaq, and all those can be influenced by a variety of factors beyond just individual economic indicators, while negative earnings, downturn in the housing market, and decline in gross domestic product, GDP growth, can be concerning economic indicators. So the broader market reaction to these factors depends on several multiple considerations. For example, the market expectations and pricing. For example, stock markets are forward-looking and often price in expectations of future economic conditions. And if negative earnings, a weakening housing market, a declining GDP growth signal or signaling potential economic challenges ahead, investors may become cautious and adjust their expectations for corporate profitability and overall economic health. So this can lead to selling pressure on the stock. So as the psychology plays a very big role, especially greed, like fear itself too. Then we have interest rates and monetary policy that are influencing the companies, like central bank policies, especially interest rate decisions, monetary stimulus measures, which can significantly impact so all those measures and stimulus can significantly impact stock markets. If economic indicators signal weakness, central banks might respond by maintaining accommodative policies like low interest rates or rising the interest rates, right? We have seen that. Or not to cut the interest rates. And conversely, concerns about inflation or economic overheating might lead to expectations of tighter monetary policy, which can spook stock market. So we have the risk appetite, we have the investor sentiment of the markets, we have the sectoral and company-specific factors. Not all those sectors and companies react the same way, the macroeconomic data. So industries like Technology, for example, represented heavily in the Nasdaq, may be more sensitive for economic growth prospects, while defensive sectors like utilities or consumer staples may be relatively resilient. And last not least, we have seen that company-specific news, earnings, reports, regulatory developments can also be impact individual stock prices, broader indices. So, and of course, the global market dynamics, like stock markets, are interconnected globally, and developments in international already the negative earnings of Facebook, of many other companies, for example, are influencing this market. And so investor sentiment, risk appetite is going back. The sectoral company specific factors like semiconductors are going down. The tensions with China is increasing. The global market dynamics is becoming worse, so stock markets are interconnected globally. Developments in international markets like geopolitical tensions, trade policies, sanctions on Iran, the war, then global economic trends can be influenced investors' behavior, spill over the US market. So, with other words, if we look at the market, we see that the tendency is relatively going down. There are some who are, of course, making that day trading and looking only bar after bar. So what I'm not recommending, guys, because you need to have your own trading styles, right? So you want to go always in direction with the trend. So that's what I can recommend. And well, what should I say? So you got all the trade plan. Bitcoin is going down. We are short. Cryptos, we are all short. In gold, it's threatening to collapse back again. The dollar is going to get much more stronger. And the stock market, finally, if the Nasdaq goes below 17,000, then we are officially then in bearish market. So if it's not holding that level, it just means that the market will go deeper to around 10,000, something like that. And we are not still in the summer pause, right? So that's the reason that if you have no trading plan, so I don't know, you must create something. Write me, I can help you to create some. If you have one trading plan, then try to catch the trend. It doesn't matter on which time frame, but go always with the bigger picture, because the odds where you can make more money is always in direction of the trend. There is no other chance that somebody else is telling I am buying the market when it rises, then he is trading the short-term trend is going up too. So without trend, there is no other chance. That's all what I can say. And I hope then you will have a very, very good time. And until the next video, so subscribe to the channel. If you have some specific questions, write it in the comments below, guys. If you're not asking anything, I don't know how I can help you there, okay? So, and of course, look at your account balance. If the account balance is growing, then your trading system is a good one. It is flattering, going up, coming down, going up, coming down. And after 1 year, you are still there where you have beginning or you have less money then your trading plan is a very bad trading plan and you may need to improve it. Therefore, you are in this channel and ask me, I can help you. All right, guys, then have a good time and have a good profitable day today. Tomorrow, we will have the next important data, but I'll make another video.